Welcome back. It's time now for Past Picks. Mike Philbrick visited with us about a year ago exactly. That was January 26th, 2024. One of his picks on that day was the Global X Seasonal Rotation ETF, HAC, on the TSX. I believe it may have had a different name a year ago, but the company, the provider, correct, has changed its name to Global X. Yeah. So with that in the background, total return here plus 11%, Mike.
Yeah, and so HAC is nicknamed HAC is sort of that seasonal rotation ETF. So a very different and unique way to look at the markets. So they will be looking at stock markets, commodity markets, and they rotate based on the seasonal aspects of what's happening. So I think people have probably heard sell in May and go away for stocks. There's also those types of seasonal impacts happen in oil, in gold, and other assets. And so they use that, and you can see how smooth the line has been. So part of that ETF is looking at exposures that are generated by sort of different metrics than we would have typically, and it reduces risk. So you've got a little bit of a risk-return trade-off. And I think what we were looking at the beginning of last year was diversifying, which didn't work, right? It was S&P 500 all day. But this is, again, one of those diversifying holdings that I think can show support during difficult markets, given its slightly different way of allocating assets.
Okay. Number two on that day, the Cambria Foreign Shareholder Yield ETF, FYLD. Looks like it trades in Chicago, if I'm not mistaken, correct?
Yes. And so Cambria has got the shareholder yield suite of ETFs. They've got one for U.S. markets, for foreign markets, and for emerging markets. And the shareholder yield concept is one of the dividend is not the only thing you're being paid. If there's debt being paid back in the company or there's being options issued, those affect actually how much cash flow the company is generating. So the shareholder yield screen helps you screen for higher quality companies. Sadly, the attempted diversification, though, once again failed. And diversification is always about saying sorry. But this is foreign stocks, not U.S., not Canadian, and it's a very high quality screen in a way to get the better companies in a portfolio.
Excuse me, number three on that day in January, about a year ago, the Harvest Healthcare Leaders Income ETF, unhedged, HHL.B on the Toronto Stock Exchange, total return plus 12%.
Right, and a lot of people are this had a really good run mid-year, and it is basically the largest healthcare companies in the world. There's a covered writing aspect to this. They write about a third of the portfolio, so not writing the whole portfolio, again, providing that upside participation for investors as they go. But then we started to see more clearly that maybe Trump was going to get into office and maybe there was some change afoot with respect to healthcare companies. And you've really seen those types of companies sell off. You've seen Eli Lilly and these types of companies who are big members of this take it on the chin. Now, ISRG, Intuitive Surgical, different because it's the mechanical stuff. So there's a lot of change afoot in the healthcare sector given the change in power in the United States, which probably puts it on the back burner for a while, sadly. So, that area, if you want to hold it, you're getting a good yield while you wait. But, it's certainly not showing sort of relative strength against the rest of the market.
Those stocks are big dividend payers. The difference between the return and total return was substantial.
Right, and part of that is that the yield comes from the covered writing as well. So it's the dividends and the covered writing. And so that is that excess return you're getting while you're writing when you're in kind of that sideways down market.
Those are Mike Philbrick's past picks from a year ago. We'll be back with Mike right after this. He's Chief Executive Officer of Resolve Asset Management. He'll resume taking your questions on exchange-traded funds.